we do have, and it's just an opportune time to have her Managing Director and Chief Economist, India and Asia ex-Japan at Nomura. Sonal, good morning to you. Thanks so much for taking the time out. This is Neeraj here. Good morning. Sonal, how do you view this dichotomy between the recency of the data that has come into India, wherein the CPI numbers have been in line, November IIP was shown a bit of an uptick as well, but globally, yields seem to be really surging. I mean, how does this impact policy? How does this impact sentiment?
It clearly complicates policy making for most emerging markets, including India. There is clear divergence in terms of the macroeconomic outlook in the US and generally speaking, I would say rest of the world. So US, of course, we've seen the strong jobs report, which has shifted market expectations on Fed rate cuts. And we have an incoming president who has said that tariffs are coming. So the big fear really is elevated inflation and potentially higher fiscal deficits, which is also raising long-term yields in in the US. I think from India's perspective, I mean, data, if I were to summarize the data, I would say growth is actually still coming in below trend. And the inflation outlook is looking a lot more benign. Obviously, we'll need to incorporate the impact of a weaker currency and higher oil prices. But monetary policy domestically, the macro outlook actually calls for lowering interest rates. But the global backdrop in terms of stronger dollar, high US rates is actually really increasing the policy dilemma. And that's where we stand today.
Sonal, hi, good morning. Tamanna here, and great to speak with you after quite some time. You know, we started the conversation with the CPI data, and that's apt. But I just want to take it a little broader, because people watching this right now are possibly wondering that what do all these global cues mean for the Indian economy and the outlook here. So you're seeing bond yields spike the way that they have. You're seeing consistent dollar outflow out of Indian equity. That continues to happen. And you're seeing now the scope of interest rates in the US also come down fairly sharply in terms of outlook. What does that mean for us?
It basically means that monetary policy in most emerging markets is getting constrained, and because of rising, currency depreciation risk and higher bond yields in global markets, financial stability actually becomes quite paramount for policymakers globally. In our case, this is coming in the backdrop of almost 1.5 years of extremely stable currency. And therefore, the currency weakness in India is not an India-specific phenomena. It is a global phenomena. We are seeing the pressures in rest of Asia as well. But RBI has been one of the, I would say, at least so far, barring the move yesterday, has seen one of the biggest FX interventions actually since October. And as a consequence, the tightness in domestic banking system liquidity, the increase in short-term rates we have seen as a result is essentially tightening banking system liquidity, and it means that the policy transmission in India is essentially constrained. So, interest rate cuts or not actually is now secondary. The starting point is that banking system liquidity is in such a deficit that any transmission from banks' perspective is not going to happen till the liquidity conditions improve. And I think that's basically bringing question marks on the growth outlook. The second is there seems to be some shift in the RBI's FX management strategy. So compared to the very heavy FX intervention, they are allowing currency to weaken a bit more, which in our view is the right strategy. Of course, that means that there will be some imported inflation in the country. And the consequent impact on the monetary policy as a result of this. And the third dynamic, which is actually a very near-term dynamic, is the US sanctions on oil and the increase in oil prices we have seen. The spillover to domestic inflation through the oil price channel may be less, but clearly the imported oil bill is going to put pressure on the current account balance, and that again feeds into the currency and potentially to inflation. So the net really in terms of the impact on India is that the forward outlook on growth is looking a bit more shaky. And the policy levers that are available for emerging market central banks like India are also getting constrained because of this global backdrop.
Well, Alex joining in, just to move that further, you say that liquidity needs to be addressed. The measures that the RBI is currently undertaking, do you think that more of the same needs to be done? What else can be done? And while you say that the rate changes or the rate cuts are secondary, what is your base case assumption for this year? And how much of an impact will the Fed's direction and decisions have on India monetary policy?
Yeah, sure. So, the starting point really is that banking system liquidity is actually over 2.5–3 trillion in deficit right now. And in terms of the tools that are available, essentially there are multiple tools, but what we need right now is really a durable liquidity injection. This can come through more longer dated variable rate reverse repo auctions. The RBI can do a buy-sell FX swap. It can do more open market bond purchases. I mean, this could be in the primary market, could be in the secondary market. And of course, it has the option of also cutting the cash reserve ratio. It could be a permanent cut. It could be a temporary cut. So there are tools that obviously are available for the RBI. And given the liquidity situation, actually, there isn't a one tool that's going to address the challenge, because if you look forward, it's likely that the pressure on currency is likely to continue. So, a managed depreciation from the RBI means that there will be some liquidity drain continuing because of some FX smoothing operations. So a mix of different tools on liquidity will need to be implemented, because if you think about banks, I mean, their funding costs have now gone up substantially. And effectively, the overnight rate is significantly above the repo rate right now. So there has been some stealth tightening actually that has happened, which needs to be reversed if we want any policy transmission to take place, which is why I'm saying that liquidity is actually step number one to begin with. Now, to what extent will RBI be constrained because of Fed policy? So if you look at market expectations on Fed, markets are now expecting hardly one rate cut in 2025, which is actually in line with Nomura's base case. Different central banks, of course, have different sensitivity to FX. I mean, in India's case, the mandate is a flexible inflation targeting regime, which means that monetary policy is not necessarily hostage to what's happening to currency. But if currency is weakening and it leads to higher imported inflation, then that needs to be incorporated in the monetary policy response. What's happening right now is we are seeing a cooling down in food prices, which is actually great news for us. So vegetable prices have come down, pulses are coming down, and January CPI, on our estimate, currently is tracking around 4.5% compared to the 5.2% reading we had in December.
Right.
And on average, in the next 12 months, we are expecting CPI inflation in the 4–4.5% range. Incorporating some more currency depreciation.
Sonal, let me come on that point, and that's actually a huge relief if you're going to see a sharp downtick in CPI in Jan, and then inflation cooling off their own. You said earlier that perhaps the RBI is letting the currency find its level right now. My question is, in your estimate, how low can the rupee go? I mean, those 90 rupee to the dollar estimates out there, are you, is that something you're subscribing to?
It's actually a function of how globally things play out. So, I mean, our current forecast, which is actually getting closer to the spot rate right now, is 87 by mid-2025. I mean, can there be an overshoot because of global developments? Definitely. But I think this is the right strategy, because the alternative of trying to peg the INR at certain level with the consequence that we tighten domestic liquidity even substantially doesn't really work in India's case, because you have an economic system which is more banking driven, and the kind of capital inflows we get are more growth sensitive capital flows. So it is important to also stabilize growth expectations in India. And if growth expectations don't stabilize, then the risk is we will see some more capital outflows irrespective of what happens globally. So I think a mix of letting the currency adjust, smoothing out the process of adjustment. And importantly, we are in a global backdrop where there is a big focus on what's happening on fiscal finances. And so it is important that in the coming budget, we send a very clear signal that the government is continuing down the path of fiscal consolidation that it had laid down, previously.
All right, thank you for that, Sonal. And a lot of clear outlook there, very, very, precise sort of forecast coming there from Nomura and Sonal Verma. Thank you for that. 87 is the level where you could see the rupee. We need a clear direction coming in from the budget. Inflation could cool off in Jan and more so going forward.